You've been told a story about the dollar. It's a story set in Washington, D.C., in grand marble buildings, where wise officials from the Federal Reserve carefully guide the world's most important currency. They raise rates, they lower rates, they print money, they shrink their balance sheet, and we all watch, believing this is where the action is. But what if I told you that story is a comforting fiction? What if the real dollar, the one that actually moves markets, ignites crises, and holds the fate of the global economy in its hands, lives somewhere else entirely? It exists in the shadows, a ghost in the machine. It's a dollar that operates outside of national borders, beyond the reach of regulators, and is born not from a government printing press, but from the simple, powerful incentives of global banks. These banks have woven a web of credit and liquidity so vast, so intricate, that most policymakers don't even know how to map it, let alone control it. This is the story of the Eurodollar system, and understanding it changes everything. You thought you knew about money. Before every major financial shock, you can remember the crash of 1987, the bond massacre of 1994, the great financial crisis of 2008, the European sovereign debt crisis, the repo market seizure of 2019, the COVID crash of 2020, and the turmoil of 2022. This hidden network was already sending out warning signals. It was trembling, tightening, and screaming that something was wrong. But almost no one was listening. Why? Because everyone was looking in the wrong place. They were obsessively watching the Federal Reserve's every move, while the true engine of global money was humming and then sputtering offshore. This offshore system is invisible, untaxed, unregulated, and undeniably powerful. The term Eurodollar is a bit of a misnomer. It has nothing to do with the euro currency. It simply refers to any US dollar deposit held in a bank outside the United States. It could be in London, Tokyo, Singapore, or the Cayman Islands. These aren't physical dollars shipped overseas in crates. They are ledger entries, bookkeepers' pen strokes, digital promises created out of thin air by commercial banks. This isn't a conspiracy theory. It's not some wild guess. It's simply plumbing, financial plumbing. It's complex, it's opaque, and its consequences are brutal. When liquidity in this system evaporates, entire countries can go silent financially. When it expands, global economic booms can materialize from nowhere, with politicians happily taking credit for a tide they didn't create. And when this system cracks, even the mighty Federal Reserve is reduced to a mere spectator, scrambling to react to forces far larger than itself. So how did we get here? This story isn't about heroes or villains. It's about incentives. It starts after World War II, when global trade began to boom. The world needed dollars to finance this trade, but the supply of official dollars from the US was limited. Global banks, particularly in London, saw a massive opportunity. They realized they didn't need to wait for physical dollars to arrive from America. They could simply create dollar-denominated loans and deposits on their own balance sheets. If a company in Germany wanted to borrow dollars to buy oil from Saudi Arabia, a bank in London could just create a dollar loan for the German company and a corresponding dollar deposit for the Saudi oil producer. No dollars ever had to cross the Atlantic. It was just a balance sheet expansion. A dollar was created by a private bank for a private transaction entirely outside the US banking system. And it worked beautifully. This invented dollar supply exploded from the 1950s onward, becoming the essential grease in the wheels of global trade, commodities, and finance. Here's the part they never told you. Today, a huge portion of what we call dollars in the world, some estimates say well over half, were not printed by the US Treasury or issued by the Federal Reserve. They were engineered into existence by the global banking system. They are promises, IOUs, circulating in a closed loop, all denominated in a currency that no single central bank truly controls. And that's the critical point. Because no central bank controls this system, no central bank can fully rescue it when it breaks. Every crisis we've witnessed is, at its core, a crisis in this offshore dollar system. It's not a race for cash in the way you might think. It's a frantic scramble for funding, for high-quality collateral like Treasury bonds, for the settlement of all those dollar-denominated promises that were created far from American shores. This is why central banks always seem to be one step behind. It is why you suddenly hear about emergency swap lines being opened between the Fed and other central banks. Those swap lines are desperate attempts to pump official dollars into the offshore system when the private, bank-created dollars disappear. It's why emerging markets, which are heavily reliant on this offshore funding, are always the first to break when the system tightens. It is why you can have a global funding collapse even when the Fed is publicly announcing easy money policies. The Fed might be easing in the US, but if London and Tokyo are tightening, the world feels the squeeze. The Eurodollar system is built on two fragile pillars: trust and leverage. Banks trust that other banks will honor their dollar IOUs. They leverage their balance sheets to create more and more of these IOUs. The whole machine works as long as everyone believes liquidity will always be there tomorrow. But then, one day, it isn't. A bank gets nervous. It stops lending to another bank. That bank, in turn, stops lending to others. Trust evaporates. The credit creation machine slams into reverse. And that's when you get a crisis. When that day comes, central bankers don't control the situation. They chase it. They react. They try to plug holes in a dam that is bursting in a dozen places they didn't even know existed. The real dollar network, moving silently through the world's financial centers, can break faster than any policymaker can possibly react. So, when you hear about the next financial crisis, remember this. Don't just look at Washington. Look offshore. Look at the plumbing. Because what you're about to see isn't the story of the dollar you think you know. You might think the answer is simple. The U.S. Federal Reserve prints them. But what if I told you there's a much larger source of dollars? A shadow system that operates beyond the control of any government or central bank. A hidden financial architecture that quietly governs global money. Through initiatives like the Marshall Plan, American corporations expanding abroad, and global trade, U.S. dollars began flooding the world. It was the undisputed global currency. But here's where things get interesting. Foreign banks, from London to Tokyo, started accumulating massive amounts of these dollars. They had a choice: either send them back to the U.S. and deposit them in American banks, or hold on to them. Now, parking those dollars in the U.S. meant they would be subject to American banking regulations, reserve requirements, and capital controls. For a foreign bank, that was a bit of a headache. So, they found a loophole. What if they held those dollars outside the United States? In a London bank, for example, the money was still denominated in U.S. dollars, but it existed completely outside the Federal Reserve's jurisdiction. There were no U.S. laws governing how they could be lent out, no reserve requirements limiting their leverage, no central authority peering over their shoulder. This was the birth of the Eurodollar. The name is a bit of a misnomer. It doesn't have anything to do with the euro currency. It simply refers to any U.S. dollar deposited in a bank outside the United States. These weren't physical stacks of greenbacks being shipped across the ocean. They were just accounting entries, digital promises on a bank's ledger. But these entries had incredible power. They formed a parallel, offshore dollar system, created not by a government, but by the private banking sector itself. Imagine a bank in London with a surplus of dollars. It could lend those dollars to a bank in Singapore. That Singapore bank could then lend them to a Brazilian company that needs to buy equipment from Germany. The German company gets paid in dollars and deposits them in a Swiss bank. Notice what happened. A whole chain of transactions, all in U.S. dollars, without a single one touching American soil or the U.S. banking system. This offshore network was incredibly efficient, flexible, and profitable. It allowed capital to flow freely across borders, fueling global trade and investment. And it grew fast, much faster than the official, onshore dollar system managed by the Fed. By the 1960s, the Eurodollar market was already big enough to influence interest rates back in the United States. Think about that for a second. A private, unregulated market was starting to dictate terms to the world's most powerful central bank, By the 1970s, when the world was hit by oil price shocks and currencies started floating freely, the Eurodollar system was there to provide the liquidity the global economy desperately needed. It became the backbone of international finance. By the 1980s and 92nd, it wasn't just about simple loans anymore. The Eurodollar system became the foundation for a dizzying array of complex financial instruments, like derivatives, swaps, and futures. It was the grease in the wheels of globalization. Even the Federal Reserve had to quietly admit that the amount of dollar-based credit created offshore had surpassed the amount created onshore. But this incredible growth came with a hidden, dangerous flaw. How are these offshore dollars created? It's not a printing press. They are created every time a bank in this network makes a new loan. Since they are just balance sheet entries, a bank can essentially create new Eurodollars out of thin air simply by extending credit. This means the world's effective dollar supply was no longer controlled by the Fed. It was controlled by the risk appetite of thousands of private banks around the globe. As long as confidence was high and the global economy was booming, the system worked like a dream. Banks were happy to lend, creating more and more Eurodollar liquidity. This kept funding costs low, credit abundant, and global trade surging. It was a golden age of financial expansion. But underneath all this prosperity was a ticking time bomb. What happens when the confidence disappears? What happens when banks get nervous and stop lending to each other? Remember, the system has no central bank. There is no lender of last resort. There is no official backstop. When a crisis hits the onshore U.S. banking system, the Federal Reserve can step in, inject liquidity, and guarantee deposits to prevent a collapse. But in the vast, stateless ocean of Eurodollars, who would play that role? The answer, as the world would discover in 2008, was nobody. The global financial crisis wasn't just a U.S. subprime mortgage problem. At its core, it was a crisis of the Eurodollar system. When the panic started, banks stopped trusting each other. The creation of offshore dollar credit froze solid. This wasn't a small disruption. It was the entire global financial plumbing seizing up. Companies all over the world that relied on this offshore dollar funding suddenly found themselves cut off. The system that had fueled globalization for 50 years had suddenly gone into reverse, triggering a massive, synchronized global contraction. It was a stark reminder that the shadow money system, which operates without rules or ruler, has two faces. In good times, it's a powerful engine of growth and prosperity, but in bad times, its lack of a safety net can amplify a crisis on a global scale. The central banks of the world, including the Fed, were forced to improvise, creating emergency dollar swap lines to pump liquidity into the collapsing offshore system. They were essentially trying to become the lender of last resort for a system they didn't control and barely understood. See, when this offshore system works smoothly, money flows across the globe, financing trade and investment. But when it breaks down, the world freezes. And unlike the US banking system, there's no Eurodollar Federal Reserve to step in and save the day. There's no official backstop. When the plumbing gets clogged, crises don't just happen, they explode. This wasn't a sudden development. The seeds were sown back in the Cold War. The Soviet Union, fearing the US would seize its dollar holdings, decided to park them in European banks, mainly in London. This was the birth of the Eurodollar market. Then, in the 1970s, oil-rich nations flooded these same European banks with petrodollars after the oil price shocks. The system grew larger and larger. In the 1980s, Latin American countries borrowed billions of these offshore dollars, only to face devastating crises when US interest rates shot up. With each decade, the world became more addicted to this offshore dollar liquidity, but almost no one understood the risk. The core lesson was being missed. The bigger the Eurodollar system got, the more the global economy depended on a form of money that no single central bank could control. The entire system was built on a fragile foundation of trust and leverage. And in 2008, that foundation cracked. We all remember the 2008 financial crisis as a story about bad mortgages in the US. But that's not where it started. The real beginning was an offshore dollar shortage, a Eurodollar seizure. Global banks, from Germany to Japan, suddenly found they couldn't get the dollars they needed to fund their daily operations. The first warning sign flashed in a market called LIBOR, the London Interbank Offered Rate. For decades, it was the interest rate for trillions in offshore dollar loans. Suddenly, the LIBOR rate spiked way above the US Fed funds rate. This wasn't just a technical detail, it was a fire alarm. It screamed that banks no longer trusted each other. They couldn't access the dollars they were legally obligated to pay back. The global financial system was on the verge of a heart attack. Faced with the global meltdown, the US Federal Reserve had to act. It opened up something called dollar swap lines with other central banks. This wasn't an act of charity, it was an act of desperation. The Fed realized the offshore dollar system had become so critical to the US and the world economy that it had no choice but to become the unofficial lender of last resort for the entire planet. It had to provide the dollars that the private market no longer could. You might think that was a one-time event, a lesson learned, but it wasn't. The exact same pattern repeated, again and again. In 2011, during the Eurozone crisis, European banks were loaded with dollar assets, but couldn't get dollar funding. The Fed's response? Open the swap lines. Between 2014 and 2016, it happened again when China's economy wobbled and emerging markets faced a dollar squeeze. And then, the big one. In March 2020, as the pandemic hit, the global demand for dollars went vertical overnight. Everyone, everywhere, wanted dollars, and there weren't enough to go around. The Fed had to inject trillions, reopen the swap lines on a massive scale, and even create new emergency facilities. The scale of these interventions made something undeniably clear. These global dollar shortages were not bugs in the system. They were features. A system built on leverage on banks creating money out of thin air on their balance sheets is inherently fragile. It works beautifully when everyone trusts each other. But the moment that trust evaporates, the entire thing seizes up. So, if you want to understand the modern world, forget what you read in the headlines about GDP growth or stock prices for a moment. The real story, the early warning signal, is in the cross-border banking flows. When Eurodollar creation slows down, the world economy slows down. When banks get nervous and reduce their leverage, crises brew. When the collateral needed to back these dollar loans becomes scarce or questionable, markets plunge, currencies collapse, and governments panic. This is the hidden architecture of our global economy. It's not really run by grand policies from central banks. It's driven by the incentives of private banks and the intricate web of their international balance sheets. From the Cold War to the Asian financial crisis, from the dot-com bust to the Great Recession, and from the Eurozone crisis to the COVID panic, the Eurodollar system has been the invisible stage where every major financial drama begins. Here's a turning point in understanding how the world really works. You finally realize the Eurodollar system doesn't just exist alongside traditional monetary policy, it completely overpowers it. This is the twist that most people never see, because we've all been taught to believe that central banks are the ultimate authority. We think policy rates dictate liquidity, that quantitative easing or tightening determines the global flow of money. But the real world is far messier. This offshore dollar network, spanning from London to the Caymans, Singapore to Tokyo, creates and destroys liquidity on a scale and at a speed that no central bank can ever hope to match. This mismatch between what we think happens and what actually happens is the quiet fault line beneath every modern financial crisis. Even the Federal Reserve, the most powerful central bank in the world, is often just reacting, it's not leading. The proof is right there in plain sight. Think about moments when U.S. policy should be stabilizing the system. The Fed cuts rates, but offshore funding costs mysteriously rise. The Fed injects liquidity, but global banks just hoard dollars and refuse to lend. The Fed pauses QT, but collateral haircuts get wider abroad. These contradictions expose an uncomfortable truth. The dollar system that truly matters isn't the one Washington controls. It's the one that global banks manufacture every single day. Here's the big twist. Central banks do not create the majority of the world's dollars. Banks do. And because banks create dollars simply by lending, liquidity can vanish almost overnight when they decide to stop expanding their balance sheets. This is why every crisis seems to start the same way. Suddenly, you hear about rising LIBOR, exploding cross-currency basis swaps, widening repo spreads, or the commercial paper market evaporating. These are all signals of a severe dollar shortage, and they appear long before journalists, politicians, or even most regulators have any clue what's happening. Let's look back. In 2007, the headlines were all about subprime mortgages, but the real stress showed up first in the Eurodollar funding markets. The spread between LIBOR and the overnight index swap started blowing out, signaling a breakdown in trust. In 2011, politicians called the Eurozone crisis a fiscal problem. But underneath it all, European banks were suffocating from a dollar shortage that no European institution could fix. Fast forward to 2019. The Fed insisted the U.S. banking system was perfectly healthy and well capitalized. Yet, overnight repo markets suddenly froze solid. Why? Because offshore dollar collateral chains had tightened, leaving even the biggest primary dealers scrambling for cash. And in 2020, before the global lockdowns even began, the FX swap market was already signaling a catastrophic collapse in offshore dollar availability. This forced the Fed to open massive swap lines before most of the world even knew it was in a crisis. Every single one of these events points to the same hidden mechanic. Global funding does not wait for central banks to act. It moves on its own. The twist gets even sharper when you consider quantitative easing, or QE. It's often portrayed as this overwhelming flood of money creation, but QE is almost irrelevant to the offshore markets unless it directly influences the availability of high-quality collateral. See, QE increases bank reserves inside the United States, but the Eurodollar system doesn't run on reserves. It runs on the willingness of institutions to lend against collateral that can be pledged and repledged multiple times across different countries. This is why a shortage of good collateral like U.S. Treasury bonds often triggers far more damage than a policy mistake from the Fed. A single dip in collateral quality, maybe European banks are holding too many risky government bonds, or Chinese companies are struggling to roll over their dollar debt, can freeze trillions of dollars in offshore liabilities within days. And when that happens, the Fed isn't setting policy anymore. It's just racing to plug leaks in a massive, global plumbing system that it doesn't own or control. But perhaps the most dramatic twist of all is psychological. The markets move long before policymakers even understand what they're reacting to. We're all trained to watch for CPI prints, unemployment data, or Fed statements. But the sequence is completely backward. The real story begins when liquidity shifts in the offshore dollar market. Prices react second, and the headlines? They follow last. This inversion explains why markets sometimes rally during a recession, or crash after strong economic data, or seem to behave irrationally around Fed decisions. They aren't reacting to the Fed. They're reacting to the vast, invisible web of the Eurodollar system tightening or loosening just beneath the surface. And this leads us to the deepest twist, the one that will completely rewire how you see global finance. The world's most powerful institutions, central banks, governments, multinational corporations, are all dependent on a source of liquidity that no one officially governs. Every country that borrows money, every company that imports commodities, every major bank, every tech giant, every single emerging economy, they all rely on the availability of these offshore dollars to function. Once you grasp this, everything else starts to make sense. You understand why the Fed needs swap lines with other central banks. You see why the IMF can only step in after the damage is already done. And you finally get why the Federal Reserve repeatedly has to become the world's lender of last resort, even though it's a job it never asked for and was never designed for. The Eurodollar system isn't just some parallel dollar market. For all intents and purposes, it is the real dollar market. And once this massive offshore engine starts to tighten, no policy, no speech, and no political promise can stop what comes next. Once you step into the mechanics of this system, the calm surface of global finance begins to look like a maze of interconnected pipes. Some are visible, but most are hidden, and all of them rely on trust and collateral, not the authority of any central bank. This isn't some abstract theory, it's a measurable, traceable reality, confirmed time and again by hard data from institutions like the Bank for International Settlements, the IMF, and even the Federal Reserve itself. The deeper you go, the more you realize this isn't just an offshore dollar market, it's a sprawling, global liquidity organism whose behavior dictates crises, recoveries, asset prices, and the flow of capital across the entire world. Let's start with its sheer size. According to the BIS, global U.S. dollar-denominated claims held by banks outside the United States now exceed $12.5 trillion. That's already larger than the quantity of all physical dollars and reserves combined. But here's the kicker, that's only the visible part. When you add in the off-balance sheet exposures, things like FX swaps, forwards, and cross-currency basis contracts, the BIS estimates that banks and non-banks outside the U.S. hold over $65 trillion in obligations. These are dollars that never appear in traditional monetary statistics. These aren't minor side markets. They are the critical funding channels for global banks, institutional investors, sovereign wealth funds, and multinational corporations. The IMF's data on global foreign exchange turnover shows that more than 88% of all FX transactions involve the U.S. dollar on one side. This incredible frequency can't be explained by trade alone. What it truly reflects is the absolute dominance of the Eurodollar ecosystem in global funding and hedging activities. So, how does this massive offshore network actually work? At its core is a simple but powerful mechanic: dollar creation through bank balance sheets. When a London bank lends $100 million to a corporate borrower in Brazil, it doesn't move deposits from New York or ship physical currency overseas. It creates a new dollar liability out of thin air, just like U.S. banks create deposits domestically. But here's the crucial difference. This happens without Federal Reserve oversight, without reserve requirements, and without being constrained by U.S. regulations. This ability to create dollar-denominated credit offshore is the very foundation of the Eurodollar system. As long as these bank balance sheets expand, the offshore dollar supply expands with them. But when those balance sheets contract due to rising risk, falling collateral values, or new regulations, the entire global dollar supply shrinks instantly. And because nearly all global trade, commodities, and cross-border finance depend on these offshore dollars, the impact is felt everywhere, immediately. This explains why we see global liquidity crises erupt even when the Federal Reserve is easing monetary policy. If offshore balance sheets collapse faster than the Fed can inject reserves domestically, the net supply of dollars to the world still falls. The data shows this with painful clarity. Take the October 2008 financial crisis. While the U.S. M2 money supply grew by about 7.5% that year, Eurodollar deposits at banks outside the United States collapsed by more than $500 billion in just a matter of weeks. The Fed was pumping money in, but the offshore system was draining it out even faster. Or consider the Eurozone crisis in 2011. The Fed's swap line usage surged to over $586 billion because European banks were facing massive dollar shortages, all while the U.S. domestic money supply was still expanding. The exact same pattern appeared in March 2020. The BIS reported that global demand for dollar liquidity exploded to the point where FX swap basis spreads, a key indicator of dollar funding stress, hit their widest levels since 2008. This forced the Fed to open unlimited swap lines with major central banks. Behind each of these episodes was the same mechanical truth: the offshore dollar system had seized up. This brings us to swap lines, which are often misunderstood but provide one of the clearest windows into the Eurodollar system's mechanics. When the Fed lends dollars to other central banks via these swap agreements, it isn't helping foreign countries out of generosity. It is backstopping the offshore dollar markets that the entire global financial system relies on. Central banks in Europe, Japan, the UK, and elsewhere weren't acting as borrowers in the traditional sense. They were acting as conduits. They were funneling dollars into their own domestic banks that desperately needed funding to meet their offshore dollar liabilities. Without these interventions, the world would have experienced a cascade of defaults, collapsing collateral chains, and completely broken funding markets. The consequences would have been catastrophic. But here's the problem: swap lines are not a permanent fix. They are emergency hoses attached to a structure the Fed does not control. To understand why this system repeatedly breaks, we have to look at the second core mechanic: collateral. Eurodollar markets don't rely on reserves, because reserves are a domestic US concept and can't be freely transferred across borders. Instead, these offshore markets rely on collateralized lending, especially in repo markets. And what is the most important collateral in the world? The US Treasury security. It is the global risk-free asset that underpins the entire offshore funding system. The BIS estimates that the reuse rate of high-quality collateral, meaning how many times the same treasury bond is pledged, repledged, and rehypothecated, often exceeds a factor of 2 during periods of market calm. In other words, a single $100 million treasury bond might be used to support $220 million of offshore dollar lending. This process, called collateral chaining, is what magnifies the supply of credit in the good times. But what happens when there's a crisis? Fear spreads, trust evaporates, and everyone wants to hold on to their pristine collateral. The reuse rate plummets. That one treasury bond that was supporting $220 million in credit might suddenly only support its face value, or even less if its price falls. This is a collateral crunch, and it causes a violent contraction in the offshore dollar supply. This is exactly what we saw in 2008, 2011, and 2020. The plumbing of the global financial system clogged up because the collateral that lubricates it suddenly became scarce. The Fed's swap lines were a response to this collateral shortage, an attempt to bypass the broken private markets and inject liquidity directly. So what does this all mean for you? It means that the next time you hear about a global financial crisis, a sudden drop in asset prices, or a mysterious surge in the dollar's value, you'll know where to look. It's not just about the Fed's interest rate decisions. It's about the health of this hidden, $65 trillion offshore system. It's about the expansion and contraction of foreign bank balance sheets and the availability of high-quality collateral like US Treasuries. This system is the true engine of global liquidity. Its booms create prosperity and its busts create crises. Understanding its mechanics is no longer optional. It's essential for anyone who wants to navigate the complexities of the modern global economy. But what happens when stress hits the system? That reuse ratio collapses. Suddenly, lenders get nervous. They refuse to accept lower quality collateral, or they demand more collateral for the same loan, a process called increasing haircuts. When this happens, the offshore liquidity that was lubricating the global economy evaporates instantly. This isn't just a theory. Think back to the repo market freeze in September 2019. Everyone blamed it on a shortage of domestic bank reserves in the US. But that was only half the story. The real catastrophe was happening offshore. Global collateral chains were tightening, and the creation of offshore dollars slammed to a halt. The proof is in the data from the New York Fed. Overnight repo rates, the cost of borrowing cash overnight, skyrocketed from around 2% to 10% in just a few hours. That wasn't just a ripple, it was a tsunami warning that the offshore collateral markets were seizing up. This is also why the 2020 crisis was so terrifying for central bankers. The Federal Reserve was forced to roll out a new emergency tool called the FIMA repo facility. This allowed foreign central banks to temporarily swap their US Treasury bonds for actual dollars. This wasn't an act of global charity. It was a desperate move to prevent a complete global collateral collapse. The Fed knew that if the offshore system froze, the entire world economy would go down with it. But there's another layer to this hidden system, a powerful signal of stress: cross-currency basis swaps. It sounds complex, but the idea is simple. It shows the cost for a foreign institution, say a European bank, to borrow US dollars. When the system is healthy, this cost is near zero. But when the basis turns deeply negative, It means foreign banks are willing to pay a huge premium just to get their hands on dollars. It's a sign of an acute, desperate funding shortage. History gives us clear examples. In December 2008, at the height of the financial crisis, the basis swap between the U.S. dollar and the Japanese yen reached negative 153 basis points. It was a 5-alarm fire. Fast forward to March 2020, and the basis swap between the dollar and the euro plunged to negative 120 basis points. These aren't just obscure numbers for traders. These were liquidity screams. The offshore dollar system was choking, and these swaps were its cry for help. Now, add another piece to the puzzle. FX swaps. The Bank for International Settlements, or BIS, estimates the daily turnover in this market is over $5.5 trillion. Let that sink in. That's larger than the entire global GDP every 2 days. This is where a huge amount of offshore dollar liquidity is created and managed. And here is the most shocking part. The Federal Reserve does not monitor or regulate these positions. This brings us to the concept of synthetic dollar creation. Imagine a Japanese bank wants to lend in dollars, but it only has yen. It can borrow yen, use a derivative like an FX swap to turn it into dollars, and then lend those dollars out. This creates a synthetic dollar supply that is incredibly flexible and dynamic. It can expand rapidly when everyone is confident and risk appetite is high. But the moment fear enters the market, it can collapse instantly. This synthetic network is driven by risk appetite, collateral availability, and hedging costs, all things that can change in a heartbeat. So who is borrowing all these offshore dollars? The International Monetary Fund reports that corporations outside the U.S. hold more than $12 trillion in dollar-denominated debt. Most of this is funded through these offshore mechanisms. When global funding tightens, these companies face a triple threat: margin calls on their loans, soaring costs to hedge their currency risk, and the inability to roll over their debt. This has nothing to do with what the Federal Reserve is doing with interest rates in America. It's a crisis born and bred in the offshore system. Emerging markets are always the first to feel this pain. Even countries with strong economies like South Korea, Mexico, or Brazil are incredibly vulnerable. Why? Because the BIS reports that their banking systems have over $4 trillion in cross-border dollar liabilities. When offshore dollar liquidity dries up, these countries suffer a funding shock, regardless of how large their central bank's foreign currency reserves are. Even China, a supposed economic superpower, is far more exposed than most people realize. Despite holding massive foreign exchange reserves, Chinese banks rely heavily on the offshore dollar market. They need these dollars to finance international trade, to support their struggling property developers, and to fund their vast shadow banking system. When the offshore dollar system tightens, you can see the stress inside China almost immediately. Their own interbank lending rates, like LIBOR, start to rise. Liquidity in the offshore yuan market, CNH, disappears, and you see Chinese institutions desperately using FX swaps to get their hands on dollars. This dynamic explains why financial crises seem to erupt from nowhere. They don't start with a big bankruptcy or a stock market crash. They start silently in the plumbing of the financial system. They begin when offshore dollar creation slows down, when collateral reuse rates fall, or when those cross-currency basis swaps start screaming. Central banks aren't in control of this process. They are reactors. They are constantly playing catch-up to a system that operates beyond their reach. The Eurodollar Network has no borders, no single governing body, and no ultimate backstop. It is a system held together by a fragile web of assumptions. The assumption that collateral will always be accepted, that balance sheets can always expand, and that liquidity will always be there when you need it. But the system's pressure points are structural, and they give us clear signals if we know where to look. In fact, there are about 10 real, verifiable signals that have historically warned us when the offshore dollar network is under severe strain. First, the LIBOR spread widening, just like it did in 2007, 2008, and 2011. Second, those negative cross-currency basis swaps getting deeper. Third, repo rates spiking unexpectedly above the Fed's target rate, like in 2019 and 2020. Fourth, a fall in Treasury collateral reuse rates, tracked by the BIS. Fifth, rising costs for non-U.S. investors to hedge their dollar exposure. Sixth, a decline in Eurodollar deposits reported in official U.S. data. Seventh, shrinking offshore dollar claims in BIS banking statistics. Eighth, a surge in demand for the Fed's dollar swap lines from other central banks. Ninth, widening credit spreads for corporate dollar funding in emerging markets. And 10th, a spike in dollar borrowing through FX forwards and swaps. Every single major global crisis of the past few decades lines up perfectly with these signals. This isn't a coincidence. This is the machine creaking under pressure. All these signals point to the same structural truth. The offshore dollar network is the true source of global liquidity, and when it tightens, the entire world tightens with it. People like to imagine the dollar system as a centralized machine, with the Federal Reserve in the driver's seat. But the reality is that the Eurodollar system is a decentralized organism. It's expansive and generous in boom times, but it becomes self-choking and destructive in downturns. And it always operates one step ahead of the policymakers who are trying to manage it. Once you grasp these mechanics, you finally understand why the Federal Reserve is repeatedly forced to act as the world's financial fire brigade. It's not because the Fed is power-hungry. It's because the Eurodollar system forces its hand. Offshore markets create more dollars than the Fed ever could. Offshore markets determine global funding conditions more than any policy rate ever will. And offshore markets can trigger a crisis faster than any central banker can give a speech. And so, every time the Eurodollar network hits a wall, the entire world turns to the one institution with the unlimited ability to print actual, physical U.S. dollars, the Federal Reserve. Everyone hopes it can stabilize a system that was, by its very nature, never designed to be controlled. Here's the final, and perhaps the hardest, truth to accept. The Eurodollar system isn't just the world's hidden liquidity engine. It is the world's hidden vulnerability. It's the central nervous system of global finance, and it has no brain, no fail-safe, and no one is in charge. Every nation, every bank, every major corporation, and every single investor is participating, whether they know it or not, in a monetary structure that was never designed. It was just discovered. And because of that, we are all living inside a global machine that expands in complete silence, but contracts with shocking violence. This isn't a prediction that the system will collapse tomorrow. It's not about doomsday prophecies or market timing. The real warning is much more fundamental. The system is structurally, by its very nature, prone to sudden, vicious tightening. And when that tightening happens, central banks around the world, including the Federal Reserve, are forced into a purely reactive mode. Why? Because the financial pressures that build up in this offshore, unregulated dollar world always hit the onshore, regulated economies last. It's like a tsunami that forms far out at sea. By the time you see the wave on the beach, it's already too late. You've seen this exact pattern repeat, again and again, for decades. Let's walk through the history, because it's a history of symptoms, not causes. The 1997 Asian financial crisis? It didn't start with bad domestic policy. It started with offshore dollar mismatches. Asian companies had borrowed cheap dollars, and when those dollars suddenly became scarce and expensive, their economies imploded. Fast forward to 2008. Everyone remembers subprime mortgages, but the real first tremor, the canary in the coal mine, was the spike in the LIBOR spread. This was a measure of stress in the offshore dollar lending market, and it was screaming red alert months before Lehman Brothers failed. The market was telling us the plumbing was breaking, but we were all focused on the house itself. Then came the Eurozone crisis. We were told it was about Greece's budget deficits and profligate southern European countries. But the initial phase of that crisis was a severe dollar shortage. European banks, which had become heavily reliant on borrowing dollars in the offshore market to fund their assets, suddenly found themselves cut off. It was a dollar funding crisis disguised as a sovereign debt crisis. The pattern continues. The 2015 emerging market crunch wasn't random. It began when China's offshore CNH liquidity, its own little slice of the Eurodollar world, completely dried up. In 2019, we had the repo market shock. The narrative was that the Fed had made a policy error. The reality? It was a problem of collateral scarcity in the complex plumbing that connects the onshore and offshore systems. The system was choking on itself. And most recently, the global panic of March 2020. Before the lockdowns had even spread globally, the FX swap markets were screaming for dollars. The price to borrow dollars for just a few months skyrocketed to crisis levels. The financial system was having a heart attack before the real economy had even caught a cold. Again and again, the world reacts to the symptoms. We blame subprime. We blame Greece. We blame China. We blame the Fed. But the real disease, the chronic condition, lives in the offshore plumbing of the Eurodollar system. And the reason this warning matters now more than ever is simple. The scale of this invisible system is beyond anything we have ever seen. The Bank for International Settlements, the BIS, which is like the central bank for central banks, estimates there are more than $65 trillion in off-balance sheet dollar exposures hiding in plain sight. These are in FX swaps and forwards contracts that function like hidden debt. Think about that number, 65 trillion. That's more than double the size of the entire US economy, and it's all off-balance sheet, meaning it's not easily tracked on standard financial statements. These are obligations that must be constantly rolled over, refinanced, or hedged. It's a massive, perpetual juggling act. And that's just one piece. Non-U.S. corporations owe over $12 trillion in actual on-balance sheet dollar-denominated debt. Emerging market banks hold over $4 trillion in cross-border dollar liabilities. These aren't just static numbers on a page. They represent a global dependency on a currency that these countries do not print and cannot control. These obligations expand silently during the good times, when dollars are cheap and plentiful. But they become an economic chokehold in the bad times, when the flow of dollars suddenly stops. And here is the core of the problem. This massive, multi-trillion-dollar system has no official lender of last resort. When a local bank in Texas gets into trouble, it can go to the Federal Reserve for an emergency loan. But when a European bank or a Korean corporation that borrowed heavily in the offshore dollar market gets into trouble, who do they call? There's no one. This is why every single tightening cycle, every time the supply of dollars gets squeezed, it becomes a global margin call. The Federal Reserve can, and does, intervene. It sets up emergency swap lines with other central banks to pump dollars into the global system. But it does so by choice, not by obligation. The Fed's legal mandate is to maintain price stability and maximum employment in the United States, not to be the world's central banker. Yet, every time a crisis hits, the world looks to the Fed to save it. And every time the Fed steps in, the world's dependency on this unofficial backstop grows even stronger. It's a vicious cycle. Meanwhile, the system itself is becoming more fragile. The collateral chains that secure all this lending are longer and more complex than ever. One person's asset is another person's liability, which is used as collateral for another loan, and so on, creating a daisy chain that can shatter from a single broken link. Leverage is more opaque, hidden in derivatives and shadow banking channels that regulators can barely see, let alone control. The whole global financial system has become hyper-interconnected, not through simple loans, but through synthetic funding, complex derivatives, and shadow finance. It's more efficient in the good times, but catastrophically brittle in the bad. So, let's be clear. The warning is not that a collapse is inevitable. The warning is that our vulnerability is permanent. It's baked into the cake. A financial architecture built on offshore dollars, with no central authority, will always be prone to sudden freezes. It will always be vulnerable to shocks in trust. It will always be exposed to collateral shortages. And it will always require the US Federal Reserve to rescue markets it doesn't even officially oversee. And one day, the sheer scale of the system may grow larger than the speed at which the Fed can effectively respond. This is the part no one in power wants to confront. A system that expands through private incentives, and the search for profit will inevitably create obligations that are too large for public institutions to manage. The next crisis will not look like the last one. It won't be a repeat of 2008, It will begin in a corner of the market no one is watching. Maybe an FX swap market in Asia starts to tighten. Maybe an offshore repo chain in London suddenly seizes up. Maybe a cross-border funding channel between Europe and the US simply breaks. The prices will move before the headlines are written. The liquidity will disappear before the experts can provide an explanation. And by the time policymakers finally gather in emergency meetings to respond, the offshore dollar network will have already redrawn the global financial map. The purpose of this is not to alarm you. It is to reveal something to you. Because once you understand the mechanics of the Eurodollar system, you start to see the world differently. You recognize its patterns. You see its pressure points. You learn to read its signals. You stop hanging on every word of a central bank governor's speech, and you start watching funding markets like the FRA spread or cross-currency basis swaps. You stop reacting to yesterday's news, and you start anticipating the liquidity cycles that are driving tomorrow's headlines. You begin to see the global economy not as a story of nations and their policies, but as a story of incentives and balance sheets. A story of credit and collateral. The Eurodollar system is the world's real financial backbone, and its subtle movements, its expansions and contractions, decide everything from the price of oil to the value of your pension fund. If there is one lesson, one single idea to take away from this entire journey, let it be this: markets do not move on their own. They are moved, and the primary force moving them is an invisible, stateless, unregulated network of credit that the world depends on but does not control. Understanding that truth is not a reason for fear. It is the first step toward clarity. Thank you for watching. If this perspective was valuable to you, consider subscribing for more deep dives into how the world's financial system really works. See you next time.